Good afternoon, listeners, and welcome to another episode of Podcast with Peter. I'm Saf from Bullsmart, and we have with us Mr. Peter Lewis, a popular financial expert who hosts the podcast show called The Money Talk. Peter talks about finance, businesses, economics, trade, and political issues specifically related to the Asia Pacific region and Asian emerging markets. Peter is a former investment bank global head of equities with experience of more than 40 years in financial markets. This is our third episode of Podcast with Peter, and in our previous episodes, Peter explained the importance of investments and various strategies in Good Investment Guide. The topic for today is Mutual Fund Made Easy. Mr. Peter Lewis will enlighten us on mutual funds and will guide us towards efficient mutual funds investment strategies. So, Peter, the mic is all yours.
Thank you, Saf, and good afternoon, everyone. Thank you for joining the podcast once again. As Saf mentioned, last week in the Good Investment Guide, one of the things we talked about was the importance of diversification. And by diversification, I mean owning a variety of different assets in your portfolio. Now, why is that important? Well, it's important because it lessens the chance that your whole portfolio will lose value in a market downturn. So diversifying across your entire portfolio, in other words, all of the investments you hold, is critical to building long-term wealth because it allows you to manage your risk more effectively. Now, obviously, stocks are one of the most talked about investments, but you don't want to tie your entire financial future to the success of a single company or even the success of just one market either. We tend to have, when we invest, what's called home bias. In other words, we like to invest in our home market, in your case, in India, because it's your local market and it's a market that you know well. But what you want to do is you want to have a broad range of investments that give you a portfolio diversification and allow you to manage risk. And that could be in things like stocks, in bonds, in precious metals, in commodities, in real estate. Now, why does that help you? Well, it's because each of those assets have a different underlying driver. That means that they move in ways that are not necessarily correlated with each other, and they move dependent upon different factors. So if you have stocks and bonds, for example, in your portfolio, stocks may be going up while bonds are going down and vice versa. So it's important to have a well-constructed portfolio with different types of assets. And if you have a stock portfolio, a variety of different types of stocks. So that's a good starting point. Those steps aren't going to guarantee you complete financial independence, but they're a very good starting point, and they can help you amass your savings, build a good portfolio, and allow you to build wealth for a better financial future. So as you get more experienced, you're going to want to start investing in individual stocks. So therefore, you need to do research on the companies that you consider. You need to think about things like, do those companies have good track records? Do they have good management? Is the stock price reasonable? Does it help diversify your portfolio, or is it similar to things that you already hold? They're all considerations that you're going to have to do to make informed investment choices when you come to invest in individual stocks. But what if you're new to investing? What about if you don't really feel confident enough or comfortable yet to pick your own stocks and to construct your own portfolio? Well, the solution is to let an experienced fund manager do it for you. And that's where mutual funds and exchange traded funds come in. Instead of buying stocks yourself, where you buy into the share of a company, instead you buy into the share of a fund. So we're going to look at how that works in more detail. And today I'm going to focus on mutual funds. And tomorrow I'm going to focus on their close cousin, exchange traded funds. And we'll talk a bit tomorrow about the difference between the two. So what is a mutual fund? Well, a mutual fund is a company that pools the money from many different investors and then invests that money in securities such as stocks, bonds, short-term debt, and so on. And the combined holdings of the mutual fund are known as its portfolio. Now, you as the investor, what you buy is you don't buy shares in individual stocks, you buy shares in the mutual fund. And each share that you buy in the fund represents your part ownership in the fund and your part ownership of the income that it generates. So when you buy a mutual fund, you get a more diversified holding than you would with buying an individual security. And you can enjoy the convenience, if you want, of automatically investing every month into a mutual fund, subject to various minimum investment requirements. So why are mutual funds so popular? Why do people buy mutual funds as opposed to buying individual stocks? Well, I think there's 4 reasons. The first one is if you buy a mutual fund, you get professional management. The fund manager does the research for you. They select the securities and monitor the performance of the stocks. You don't have to start delving into all the individual stocks and analysing their performance and going through annual reports and balance sheets. The professional fund manager will do that for you. So that's the first reason and the first advantage, if you like, of buying a mutual fund. The second one is it achieves this target that we've just been talking about of diversification. In other words, you're not putting all your eggs in one basket. Mutual funds typically invest in a range of companies and industries. So this helps lower your risk if one of those companies were to fail or go bankrupt. The third reason is they are affordable. Most mutual funds set a relatively low amount for the initial investment and for subsequent purchases. So you can buy into a mutual fund, buy your share of the mutual fund at a reasonable amount, a reasonable level. And then fourthly, mutual funds provide liquidity, providing they are what we call open-ended funds. So what that means is that you can redeem your shares at any time you like for what is the current net asset value of that fund. And I'll explain what I mean by that in a moment. But each day there is a price at which you can, if you like, buy into the fund or later on redeem your investment in that fund after paying any redemption fees. So they're the 4 reasons why people buy mutual funds and why they're popular. Professional management, you get diversification, they are affordable, and they are liquid. Now, there's several types of mutual funds out there, and they fall into one of 4 main categories, which are money market mutual funds, bond funds, stock funds, and then what we call target date funds. And each type of mutual fund has a different feature, risk, and reward. So money market funds have relatively low risks. They are constructed so that depending upon the regulations in each country, they can normally only invest in certain high quality short-term investments that are normally issued by the government or local governments or by the country's corporations. But they are supposed to be low risk and they are supposed to be highly liquid. Now, bond funds have a higher risk than money market funds because they aim to produce a higher return, but nevertheless, they can invest in high quality government bonds. They can also invest in corporate bonds, or they can invest in mortgage-backed securities. Then stock funds, as the name suggests, invest in corporate stocks. Not all stock funds are the same. There's many different types of stock funds, but you could have a growth fund that focus on stocks that may not pay a regular dividend, but they have potential for above average gains. There are income funds that invest in stocks that pay regular dividends. Here in Hong Kong, income funds are very popular for paying out a regular dividend. Then there's also index funds, which track a particular market index, such as the Nifty 50 or the Sensex, or overseas the S&P 500 index, and so on. And then there are sector funds which specialize in a particular industry segment. So there's many different types of stock funds amongst the mutual fund category. And then finally, target date funds, what they do is they hold a mixture of stocks, bonds, and other investments. And what happens is that over time, the mix shifts according to the fund's strategy. These funds are sometimes known as life cycle funds, and they're designed for people who have particular retirement dates in mind. And then they help you reduce the risk as you get closer and closer to that retirement date. So what are the benefits and risks of mutual funds? Well, first of all, they offer three ways in which you can earn money from them. The first one is through dividend payments. A fund can earn income from the dividends on all the stocks that it holds, and also the interest on all the bonds that it holds, and the fund then pays the shareholders nearly all of that income to the owners of that fund, less expenses. The second thing you get is you get capital gains distributions. The price of the securities that the fund is holding can increase. And if the fund sells the security at a higher price, then the fund has a capital gain. And at the end of the year, the fund distributes these capital gains minus any losses to investors. And then the third thing is you get an increased net asset value. Now, the net asset value is the market value of the fund's total portfolio after deducting expenses. So it includes the things that it has unrealized gains on, but yet hasn't yet realized those gains, hasn't sold them. Each day you can see a net asset value of that fund as the share prices and the bond prices of all the components of that portfolio change. And the higher net asset value reflects the higher value of your investment. And when you come to redeem your share in the fund, if you redeem it at a higher net asset value, you will get more back than what you put in the first place. But I don't want you to think that funds don't carry any risk. All funds carry some level of risk. And with mutual funds, you may lose some of your money. It is even possible to lose all of your money, although it's less likely for that to happen than if you invest in individual securities. But don't forget, the value of the securities in a fund can go down in value as well, and dividends and interest payments can also change as well as market conditions change. So a mutual fund is not risk-free, but it should be safer than investing in single stocks and you putting all your money in, all your eggs into one basket. And the other thing to bear in mind is that people often focus when they look at mutual funds on a fund's past performance. Now, that's not as important as you might think, because what happens in the past doesn't predict necessarily how that fund is going to perform in future returns, although the past performance can tell you how volatile or how stable that fund has been over a period of time. And the more volatility you see in that fund, the more volatility in the price and the net asset value, then the higher the investment risk. Volatility equals higher investment risk, higher volatility, higher risk. And the total return of the fund, that represents the change in value, up or down, of the investment over the specific period. So you often see the total return quoted when you look at figures for mutual funds. That includes any interest, any dividends, any capital gains that the fund has generated, as well as the change in its market price. And you'll often see, when you look at fund returns, you'll see fund returns for certain periods, such as 1 year, 5 year, 10-year periods, as well as since the day the fund opened up, which is called the inception date. So you will often see these numbers, these returns. And I'm going to talk in a moment about what you can glean, what sort of information you can glean from these types of these numbers. So how do you buy and sell mutual funds? Well, you do it just in the same way as you buy any other stock. You buy them through a broker. The broker will be able to buy and sell your share of these mutual funds for you, and the price that you pay for the mutual fund is the net asset value of the fund on that particular day, plus any fees which are charged at the time of your purchase. And those mutual funds are redeemable, so you can sell the shares back to the fund at any time. And the fund, there's normally regulations about how quickly, in what time frame, the fund must send you back the payment when you redeem. But you've still got to decide on which mutual fund to buy. So there are still choices to be made. Just like when you buy a share, you have to make some choices. You have to make some choices when you buy shares in a mutual fund as well, maybe some different choices from buying individual stocks. Now, the first way to help you make the right choice is to read the fund's prospectus. Every fund will have a prospectus. You can either download it online or you can go and get it from your broker or financial advisor. And that prospectus contains information about the mutual fund's investments, objectives, risks, performance, all the expenses that they will charge. It's an important document, and I do recommend that before you buy a mutual fund, you read that fund's prospectus to learn about more key information about the particular fund before you buy. So you'll want to find funds with solid track records. You'll also want to find funds with reasonable fees as well, because that makes a big difference. Now, there's many sites that you can go to. Yahoo Finance will provide you a lot of information on mutual funds. Morningstar provides a lot of information on mutual funds. So having got this information, having got the prospectus, how do you select your mutual fund? Well, the first thing to consider is whether the fund's investment objectives are aligned with your long-term financial plan. Now, if you're beginning out your investment career, maybe you want to invest in a low-cost index fund. So that could be an attractive option. It's important to make sure then that the fund that you're investing in aligns with that particular investment. If you're a more experienced investor, you might want to look instead in investing in an actively managed fund, in which case you're probably going to need to do more research into the fund about who the portfolio manager is, what his approach is to managing that fund. You need to understand the fund's overall approach and investment philosophy, and who the portfolio managers are that are going to be making the investment decisions on your behalf. And ultimately, a fund's performance is what counts for you as an investor. That's what matters. So you need to understand what are the drivers of the fund's long-term performance, and also decide, do you think that's going to continue in the future as well? And you'll also want to consider the fees associated with purchasing your shares in a fund. Remember that if two funds have the same investment performance, exactly the same investment performance, the one with the lower fees are going to leave you better off. So when you select those funds, should you look at these independent fund ratings, these fund ratings that you can get from, say, Morningstar or Yahoo Finance? They're a great resource. They provide a lot of information about a fund, and they provide you ways in which you can compare mutual funds. And the answer is a little bit tricky. The answer is yes and no, because these ratings that you will see on Morningstar, on Yahoo Finance, rely very heavily on the past performance of the fund. And as I've just explained to you, past performance is not necessarily a guarantee of future performance. What can often happen is funds that can have very good track records over a period of time, over a period of several years, can suddenly lose their touch, if you like. Yesterday's winners can suddenly become tomorrow's losers. So looking at these past performance numbers, you have to be a little bit careful about them, because while they will tell you about what has happened over the last 1, 3 or 5 years, it doesn't necessarily mean that that performance is going to continue. The fund could fall out of favor, or market conditions could mean that suddenly it's much harder for that particular type of fund to make money. So rather than just relying on these ratings and these past performance numbers, what you should do is, when you select the fund, ask yourself these 4 questions. First of all, do the objectives of the fund manage your investment objectives? In other words, are they aligned with your particular goals for building up your financial future? Secondly, consider how this fund is going to fit into your overall investment portfolio. It may well be it's not the only mutual fund you buy. It may well be it's not the only thing in your investment portfolio. How does this fund fit in? Does it enhance the returns? Does it help you manage the risk of the portfolio better? You also should ask yourself, what are the risks of this particular fund? Are you comfortable with taking those risks? If you're a younger investor, you can afford to take higher risk. If you're approaching retirement, then you've got to be more careful about the risks and the risks that the fund are taking. And fourthly, you should ask yourself the question, can I find a similar fund at a lower cost? Now, you're going to find the answers to those questions and a lot more in those prospectuses. So as I say, to avoid any surprises, make sure you read those prospectuses carefully before you invest. And I want to emphasize again how important fees are in deciding whether or not to invest in a particular mutual fund. As with any business, running a mutual fund involves costs, and the funds pass along those costs to investors by charging fees and expenses. And those fees and expenses vary from fund to fund, and they can vary a lot from fund to fund. So a fund with high costs and fees has got to perform better than a lower cost fund to generate the same returns for you. And even small differences in fees can make a very large difference to the returns over a period of time. So as an example, if you invested $10,000 in a fund with a 10% annual return and it charges you annual fees of 1.5%, then after 20 years, you're going to have roughly $50,000 in your fund. But if you invested in a fund with exactly the same performance, but instead of the fees being 1.5%, they were 0.5%, after 20 years, you would have more than $60,000. So that 1% difference in fees makes more than $10,000 difference in the performance. And if you look over 30, 40, 50 years, it will make an even bigger difference. So these fees that are charged, both upfront fees and annual fees, are going to make a very, very big difference to your performance. And you can download off the internet a mutual fund cost calculator so that you can compare different mutual funds, put in the fees that are being charged, add it up over time and see how that eats into your returns. So taking into account the fees is a very, very important part of selecting the right mutual fund. Now, there are also tax benefits as well from investing in mutual funds and also exchange traded funds. Now, I'm not a tax expert in India, but I know that you can get benefits under the Income Tax Act if you invest in what are known as equity linked saving schemes, providing you invest the money for a certain period of time. You can get tax benefits from that, and also bond funds as well, where you can get tax benefits on the interest that's charged. But as I say, I'm not an expert in Indian tax, but I'm sure your broker or your financial advisor will be able to advise you more on those particular benefits in India. So let me summarize then. I want to give you 4 important reminders about investing in mutual funds. Reminder number 1, you can still lose money investing in mutual funds. They are not a guaranteed way of making money. Funds can go up and down, although because of the diversification that we've talked about, you should be able to get a better return for less risk than looking at selecting your own individual stocks. Secondly, past performance. It's not a reliable indicator of future performance, but that doesn't mean to say you shouldn't consider the past performance, because at the very least, the past performance can help you assess a fund's volatility over a period of time. And as I explained to you, higher volatility means higher risk. Third thing is all mutual funds have costs that lower your investment returns. Very, very important to consider those costs and take them into account. And the fourth reminder I want to give you before I stop talking is, before you invest, make sure you read the fund's prospectus and shareholder reports to learn about the fund that you're considering, and make sure you clearly understand the investment that you're considering, and then you'll be better prepared to make a sound investment decision. So that's mutual funds. Now, they have a closely related cousin called exchange traded funds, which are similar but also different in some important ways as well. And tomorrow, what I'm going to do is explain how exchange traded funds work, the difference between them and mutual funds, and some of the advantages and benefits of investing in exchange traded funds. But we'll save that for tomorrow. So thank you very much for listening today. And if you have any questions, I'll be happy to try and answer them.
Thank you, Peter. That was very informative, and I'm sure our investors know more about mutual funds now. Before you leave, I have some questions from audience as well as from me. So I'll start. The first question is, there are more than 5,000 mutual fund schemes in India, and every month new mutual fund enters the market as NFO. How can an investor investing for the first time should select mutual fund?
Yes, and I know that there is a massive amount of choice. You only have to look at some of the
Yeah.
websites to see just how many mutual funds there are. But remember, there's even more stocks. So, selecting a stock isn't any easier than selecting a mutual fund because, again, you have a vast amount of choice. I would say the
Mhm.
starting point for you is to consider where you are in your investment time horizon and the sort of risk that you're prepared to take. So, are you young? Are you 20 years old looking to invest for the next 40 years? In which case, you can maybe take more risk right now, and therefore, you can rule out certain types of funds. You don't need to be considering at 20 years old money market funds. Maybe bond funds are too conservative for you. So you can start narrowing down that risk, and maybe you decide, well, look, what I'd really like is a stock fund. Now, which country would you like the stock fund to be in? Would you like it to be in India? Would you like it to be in an overseas market? Would you like it to be a mixture? That will help you narrow down further the choices. So then you will get to a much smaller list of potential choices. And if you're an older investor coming up to retirement, then again, your choices are going to be different. Maybe you are interested in a bond fund or a money market fund, but you can narrow down those choices to a more manageable level. And then once you've done that, that's when you get the figures, look at the past performance of the funds, look at how they've done, look at the ratings that things like Morningstar give them, and then you'll be able to come up with maybe a more manageable list of funds that you can consider. And that's when then you download the prospectus, look through the prospectuses to start narrowing down your choice. But I do understand it's a difficult choice because there are many, many of them, but at least you can divide them up into categories, and those categories will help you narrow down the choice.
Okay, Peter. So the next question is that mutual funds itself have a diversified portfolio. Then why is it necessary to diversify the portfolio of mutual funds, like investing in multiple schemes of different categories?
Well, there's several reasons for that. I mean, a mutual fund often is itself targeted on a particular market. So, for example, a
Okay.
lot of those funds that are up on the that you will see in India are Indian mutual funds. They invest in Indian stocks and Indian bonds. So, what you may want to say
Mhm.
to yourself is, well, okay, I'll be diversified across a whole range of Indian stocks, bonds, fixed interest securities, but I'm not very well diversified globally. I'm very dependent upon the Indian economy. I'm very dependent upon the Indian market. What happens if the Indian market, although at the moment it's doing very well, it's close to all-time highs, what happens if the Indian market slumps or the economy hits hard times? Should I be looking at maybe some other markets overseas and avoiding what we call this home bias, where people tend to invest predominantly in the stocks of their own country? It doesn't matter which country you're in, people have this home bias. So you may want to diversify across countries. You may want to diversify across styles. What about, if you have an index mutual fund, for example, you may decide that you want to have more exposure to a particular sector. I mean, do you want to have exposure maybe to the technology sector and all these artificial intelligence stocks that people are getting excited about at the moment? So just like you have to diversify with stocks, just because you're in a mutual fund that is holding a lot of securities, it doesn't necessarily mean you're totally diversified or diversified enough. So helping diversify the range of mutual funds will give you a much better a balanced portfolio and diversified portfolio.
Okay. So what should be the ideal allocation between equity and debt mutual funds?
Well, that really It really depends upon how old you are really and what your investment objectives are. As I say, as you get older and start to approach retirement, you have to be more careful about the risks that you take. Your priority then becomes focused on making sure that that pot of money that you've already earned remains there, doesn't get hit by a large drawdown, by a fall in the markets, because that's what's going to pay you your retirement income. But if you're younger, then you can afford to take sort of much more risk. So really, it depends upon the mix, depends upon your age and your investment objectives, and also what are you investing for? Are you investing, as we talked about last week, for retirement? Are you investing to buy a new home? Are you investing for children's education? It's those things that dictate the journey that you're going on, and then what type of fund you should be considering.
Okay. So my next question is that during volatile market conditions or market downturns, there are many people who want to redeem their investment or withdraw their investment. At such times, how do mutual funds manage their liquidity and how they handle the redemption of investors?
Well, a mutual fund is supposed to be able to, unless it specifically says in the prospectus where it is holding illiquid securities, provides a net asset value each day, and they will guarantee that you can sell back your shares to the fund at that net asset value minus any fees. That is part of the guarantee of the fund, and it has to do it within a certain period of time. So mutual funds have to maintain a certain amount of cash so that they can meet those liquidity demands. And also, they have to be able to, if they don't have enough cash, then they have to sell securities. So they need to make sure that they have holdings that are liquid enough so that they can sell them very quickly if a lot of people want to redeem at the same time. But one of the things I would say to you is that when you have volatile markets, in many ways, the worst thing you can do is panic and suddenly start selling out of everything you own, because what tends to happen is people tend to sell out at the worst possible price. They tend to sell out at the bottom of the sell-off when really they should be hanging on, or they should be selling when they have a good profit. When everyone else is buying, that's often a good time to sell. As Warren Buffett says, you should be greedy when everyone else is afraid, and you should be afraid when everyone else is greedy. So don't necessarily follow the trend. And in particular, if you are younger, even if there is a market downturn and the fund suffers a drawdown, you have plenty of time for that to recover. But the important thing is, don't panic to market moves, especially if they are big market moves. And often when people sell after a big market move, it's too late. They've missed the boat.
Okay. I'm sure investors will remember that. You also mentioned checking the historical performance of mutual funds. What is the best way to compare past returns, and how will it ensure that the same will be delivered in the future?
Well, it won't. That's the whole point. You see, past returns are what happened yesterday. Now, certain funds, attract a lot of interest because year after year they put in a good performance and therefore they attract a lot of money. But it does not guarantee at all that you're going to get the same performance tomorrow or next year. And even good funds, even well-managed funds with high-profile fund managers, have bad periods. And it could be just your bad luck that you buy into the mutual fund just as it's about to have one of its bad periods, even though the last 5 years it was a spectacular performance. So those funds, those past performances will not guarantee you at all what the future performance is going to be. What they are is they're a historic indicator, if you like, of the fund, how it has done in the past, and also the type of risks it takes. Because if it, generates very high returns, you have to ask yourself, well, how does it do that? High returns come with higher risks. So what sort of risks are the funds taking? And that performance can tell you a little bit more about the risk of the funds. But you absolutely must understand that past performance is like reading yesterday's newspaper. It doesn't tell you much about what's happened today.
Okay. So I've seen many people choosing the funds based on the assets under management, that is AUM. So do you think that the AUM of mutual fund affect the performance or liquidity of mutual funds?
Well, it can do. Sometimes, funds can get too big, and particularly if they're specialist funds, if they do well, they can attract so much money that it starts to become difficult for them to find things to invest in because they already hold them. And even if it is, a diversified fund that invests in stocks, if that fund becomes very, very big, and sometimes they can become very big, if you look at, big global investors like BlackRock, like Vanguard, sometimes, the fund becomes so big that all it can do is look more and more like the index of the country that it's in, because there's a limit to how many large stocks that you can buy. And eventually, if you keep buying all the large stocks in a particular market, you start to look like the index of that market. So then you have to ask yourself, well, what's the point of having a fund manager just to buy me something that looks like the index? I might as well go and buy an index fund or an exchange traded fund that's going to have much lower fees and be much cheaper. So yes, the assets under management are important, and you have to look at the size of that fund compared to what it's investing in. If it's investing in small cap stocks in a particular market, if it starts to get too big, it will struggle to find enough of the right small cap stocks to invest in.
Okay, so that was all from my side, and that was a very helpful and very resourceful podcast with you, Peter. Finally, based on your experience and expertise, what advice would you give to investors and those who are planning to invest to maximize their returns and achieving their long-term financial objective through mutual funds?
Well, first thing is plan for the long term. You're not trying to make money just in 1 week or 1 month or 1 year. You're planning for the long term. So you want to look at good quality mutual funds that are run by well-respected firms with good fund managers, and also funds that manage carefully their risk. Everything we do has a risk. The key is how we manage it. Now, if you find a good professional fund manager at a well-renowned firm, a good firm, then you shouldn't have a problem. You should be able to find a wide selection of mutual funds that you can choose from.
Okay, so that would be it for our today's podcast session. We hope to see you soon tomorrow with exchange traded funds and more about mutual funds. Uh, have a nice day, Peter. And I would request all our audience to make sure to subscribe and stay updated with our all episodes so that they never miss an episode.
Okay, thank you very much. Look forward to speaking with you tomorrow.
Yeah, yeah.